Most people believe the money system is failing, that something has gone wrong, that the system is broken. But what if the system isn't broken at all? What if it's functioning exactly as it was designed to function? And the confusion comes from misunderstanding what it was built to do. If you don't understand how the monetary system actually works, you'll keep making the same decisions that feel responsible, logical, and disciplined, yet somehow don't produce the outcomes you expect. This isn't about blame, it isn't about politics, and it isn't about predictions. It's about understanding the machine you already live inside. So it's a behavior that stops feeling random. I don't want to predict markets, I don't want to claim clarity. I just want to study the system, specifically how incentives shape outcomes over time. Once you understand the incentives, the outcomes stop becoming surprising. So let's talk through how modern money actually works. So money is not paper, it is not coins, and it's not numbers on a screen. Money is actually a system designed to measure value, move value, and settle value between people across time. The bills, coins, and digits we interact with are just interfaces. They're not the system itself, and the distinction matters because when people say money is broken, they're usually reacting to how the interface behaves, not how the system is designed. In this modern system, money is not created by governments in the way most people imagine. The majority of money is created by banks through lending. See, when a loan is issued, new currency is created at the same time as new debt. There's not a pile of existing money or something transferred. New currency enters the system because new debt exists. This means that modern money is debt-based by design. That's not conspiracy, and that's just how the operating model was set up. So here's the part most people miss. If money enters the system through lending, then the system requires continuous expansion to function smoothly. Why? Because the interest on existing debt requires future currency that does not yet exist. So if expansion slows too much, defaults rise, liquidity dries up, and economic activity starts to contract. So the system is not optimized for stillness, it's actually optimized for motion. This explains a lot of frustration because currency is designed to circulate. It's designed to move from saver to spender, from lender to borrower, from business to customer. A currency optimized for circulation cannot be optimized for long-term storage of purchasing power. Those two goals are always going to conflict. So when people feel punished for saving, the system isn't malfunctioning, it's enforcing its incentives. You see? So when the supply of currency grows faster than the production of real goods and services, then each unit represents a smaller share of the total value. Nothing dramatic has to happen at all. They don't need any kind of major announcement or anything like that is required. Purchasing power simply erodes gradually. This is not evidence of failure, it's evidence of design trade-offs. The system chooses stability of motion over stability of value. Because the system depends on liquidity, volatility is not eliminated, it's just managed. Markets move not to reveal the truth, but they actually maintain flow. So prices don't exist to tell you what something is worth. They actually exist to facilitate transactions under changing conditions. Do you see what I mean? So once you understand that, volatility stops feeling like chaos and it starts looking more like feedback. Okay, so the system works at a macro level. It does not work on an individual one. It does not optimize for personal savings, long-term purchasing power, or your financial comfort. It doesn't care. It optimizes for continuous activity, debt servicing, and liquidity maintenance. So when individuals expect the system to behave like a savings machine, you're always going to be disappointed. Not because the system failed, but because expectations were misaligned. Okay? So no, the money system is not broken. It's doing exactly what it was designed to do. And the real risk is not instability. The real risk is misunderstanding the rules of the system that you are participating in. And once you understand how money works, then the fear starts to fade and clarity starts to replace it. Okay? So listen, in the next video, we'll take this one step further and explain why inflation is so widely misunderstood and why that misunderstanding quietly costs people years of effort. Okay? If this changed how you think, let me know in the comments, and be sure and hit the subscribe button and hit that like button so we can get this out to others who, might need to hear this information. And I will see you all on the next one.